According to Moody's Investor Service, Kenya's economy will continue to grow at 6.0% in 2019 and 2020, supported by the strong services sector and private consumption. Christos, Vice President, Senior Analyst at Moody's Investor Services, joins us to share if solid capital and profitability shields bank from high asset risk. Christos, thank you so much for joining us. Now, as I've just touched in the intro, do you think that solid cap and profitability shield banks from high asset risk?
Yes, Fiona. Hi, thank you for having me. On a high level, yes. I mean, we see continued challenges in the operating environment for banks, although we expect a gradual recovery over the next 12 to 18 months. So the greatest challenge for the Kenyan banks at the moment is there's still high level of problem loans, although we expect that problem loans are reaching their peak as the banks step up their recovery efforts, and we expect a bit of improvement in the liquidity and profitability of the corporate sector in Kenya. So although problem loans remains the greatest challenge, we believe that the Kenyan banks' strengths, which are the profitability, capital and funding and liquidity profile, continues to shield them from the risks posed by the high level of problem loans.
Yes, now we also see that Kenya's economy is expected to continue growing at 6.0% in both 2019 and 2020. Now, how big of the role is the private sector playing? And when we look at the government investment towards the Big Four agenda, will this have any impact?
Yeah, as you mentioned, the economy is growing by relatively high growth rates by global and also by sub-Saharan average. So 6% is our expectation going forward, which support overall the operating environment. On the other side, however, we still see some challenges in the operating environment. For example, the private sector corporates continue to face lower profitability and a liquidity crunch that impacts their cash flows and overall ability to support the economic growth. Going forward, we expect a bit of an improvement, a bit of a recovery. As you mentioned, the Big Four related spending is something that we expect to support the investment in the economy by the private sector. Also, we're hearing that the authorities are putting more emphasis on repaying some of the public sector arrears going forward. And the Big Four agenda that you mentioned is not just the government spending, but also the authorities are putting in place some business-friendly reforms in order for the private sector to step in and support those initiatives as well. So we expect a gradual recovery because of these factors going forward.
Yes, and we're also seeing that profitability at Kenyan banks, it's one of the highest regionally, but we're seeing a downward trend. Now, would you say that this is due to the government's cap on the lending rates, or what are some of the other challenges that may be hindering and causing the downward movement?
Yeah, we've seen a drop in profitability on the Kenyan banks over the past 2 years since the introduction of the lending rate cap. Obviously, the lending rate cap reduced the margins that the banks can charge. So the lending rates that the banks charge now are lower, so the net interest margins are also lower. Also, we've seen the impact of IFRS 9 that requires the banks to hold higher provisions. And also the credit growth over the past 2 to 3 years has slowed down. So all of this has impacted the profitability of the Kenyan banks. Nonetheless, as you mentioned, Kenyan banks' profitability remains quite strong by regional and global in the regional and global context, and it's one of the highest in the region. And it continues to be supported by the bank's strong efficiency, given the bank's focus on digitization, improving operating expenses, and also utilizing alternative distribution channels. The banks are looking to diversify their income. And going forward, we're also expecting a modest pickup in credit growth, all of which should sustain the current strong level of profitability, and we shouldn't see a further drop from these levels.
Yes. Now, Christos, in your own opinion, would you say that the 2016 legislative cap on the lending rates, do you think it should be reviewed?
Fiona, obviously that's a political decision, so we're not, we don't typically give opinion about the politics. However, since the lending rate caps have been imposed, we've seen the banks preferring to invest more in sovereign securities rather to lend to the private sector. We've seen the banks preferring to lend more to larger corporates rather than SMEs. So although the lending rate cap wasn't the only reason why we've seen a slowdown in credit over the past 2-3 years, obviously it had a big impact to play, and it's one of the reasons why the credit growth in the market continues to be slowed. So the lending rate caps plus the fact that the NPLs in the system continue to be quite high, that impacts overall the bank's risk appetite and their lending to the private sector as well.
Okay, thank you so much, Christos. Thank you for creating time to speak to us. Have a great day.
Fiona, you too. Bye.